Well, hello everybody. Welcome back to Strongman Personal Finance. My name is Christopher Belli. I'm a certified CPA accountant. I'm a long-term bottlehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. Go buy it now. And I'm going to give you some advice from the bottom of my heart, because a lot of you email me, you leave comments on my channel telling me that you've lost massive sums of money listening to the likes of Meet Kevin, Jeremy Financial Education, Stink Blow, and all these other freaking YouTubers that have no qualifications to analyze stocks. Now, I don't paint myself as a stock picking genius. I'm a CPA, I'm an accountant. I am not a financial advisor, even though financial advisors don't know jack either. Trust me, I used to be one. I'm not a CFA, I never worked on Wall Street. I hope I'm very clear about that. But one thing I do know how to do is look at companies' financial statements. Financial statements are records of a company's past. A company has sales, has expenses, they have assets, liabilities, equity. They have all sorts of stuff. And you can categorize that and summarize that inside a company's financial statements. And you can get a good understanding of how the company's employing its assets, how profitable they are, where their cash is going. You can get a lot of information from analyzing financial statements. So that's what I bring to the whole YouTube stock picking degenerate universe that's out there. But a lot of you were listening to people like LaFufu, Meet Kevin, and you bought a bunch of very, in my opinion, garbage stocks, at least fundamentally. Some of these stocks are down 60, 70, 80, 90%. Now, a lot of you are what I would classify as bag holders. You bought these stocks at the height of the pandemic boom, listening to these people, and now you have no idea what to do because you are down so massively that you have multiple choices facing you. Well, let me give you some clarity about your options. Number one, you can do nothing. Now, if you do nothing, let's say you bought a stock and it's down 50%, and you do absolutely nothing, one of two, well, three things can happen. The stock can trade flat for the next 10 years, and you can miss potentially a decade of compounded growth if you put it into an alternative investment. You could sell the stock at a loss, but if you do that and the stock goes back up, you'll slap yourself a little bit, but that's okay. Or you could wait till the stock goes up, which is also a possibility. I mean, anything can happen. So you could buy more, you could hold, or you could sell. Those are some options for you. Now, if you sell a stock at a loss, you actually do get some tax benefits, okay? It's not the end of the world if you lost money on a stock. Let's say you sell a stock for a $4,000 loss. Well, on your tax return, you can take all your capital gains and losses and net them out. So if you have a $4,000 capital loss and a $5,000 capital gain, you net them out and you get a $1,000 capital gain. And you can net shorts and shorts, long to long. There's a whole process to do it. But at the end of the day, you can offset your gains and losses to reduce your tax liability. Now, if you only have losses, you can write off up to $3,000 of capital losses against your ordinary income. That's your income from IRA distributions, wages, salaries, tips, pensions, stuff like that. So you could potentially save yourself a decent amount of taxes. As a matter of fact, I made a video recently where I said I was going to sell my Vanguard Total International fund, and I did. I sold it at a $3,000 loss, but then I immediately bought VT. So I just harvested $3,000 capital loss that I could use to offset any gains that I incurred. I also sold an individual stock. I had HPQ in there, and I was up 17, 18%. I sold that at a gain. But because I sold that loss with the Total International market, I can net those out. And I'm still invested in the market. It's not a permanent loss. Well, I guess technically it is, but whatever. Everything's down. So if you sell at a loss, it's not the end of the world. It's something to consider. But if you do it, you don't want to hurt. You don't want to be upset at yourself if the stock that you sold suddenly moons. Now, the other alternative, like I said, is to hold the stock. Just keep holding it. You're not going to buy it. You're not going to sell it. You're just going to hold the stock. Well, guess what? Think about what opportunities you could miss. Let's say you just held the stock and it goes nowhere for 10 years. Well, what if you had sold that stock and bought another stock, or preferably an index, and that index gave you a certain amount of compounded annual returns going into the future, let's say 5%. Well, you've missed out on 5% annual compounded returns by holding on to this stock. Now, the next thing you can do is buy more of the stock. Now, here's where it gets tricky, ladies and gentlemen. If you watch Jeremy Financial Education, he's the worst at this. He has a very, I guess you would call it, reasonable message on the surface. He basically follows all the precepts and the teachings of some of the best investors in the world. If a stock you like goes down and you believe it has long-term prospects and you have a good fundamental reason for it, it makes 100% sense to keep buying the stock as it's dipping. For example, Baba stock has gotten freaking wrecked. It's 5% of my portfolio. I'm down 20, 30%. I've been averaging down. However, there's a reason I'm buying that stock as it dips lower. It's because when I initially bought it, I had a fundamental reason why I bought that stock. So because it went down, does not freaking bother me. Now, if you did not have a fundamental reason to buy a stock that's been down 50, 60, 70%, you just listen to a YouTuber, well, that's where it gets tricky, and you really have to do some self-reflection. Because if you just take a stock tip and you don't look at any fundamentals and you just buy the stock because somebody told you to, well, you need to do some analysis and really see if that was a good decision or not. So you could buy a stock not knowing it's a good stock because somebody told you, and you could do well in the long run. But you have to actually look at the stock's fundamentals and think, okay, would I buy this stock at this current valuation? For example, let's say you bought Tattooed Trucker's sweaty, putrescent, shark-covered nutsack stock, okay? That stock has been wrecked. Why? Well, in my opinion, they are massively unprofitable. They have insanely low gross margins. They're going to have an inevitable share issuance dilution. It's probably going to be a massive issuance because their stock price is low and they need cash because they're burning it hand over fist. And they're in a highly competitive niche market where they're going to have a tough time. That's my bear thesis on Tattooed Trucker's sweaty, putrescent, shark-covered nutsack. Okay? But if you bought it because Jeremy LaFufu told you to do it, you need to look at the stock and say, okay, I see the gross margin. It's 10%. Revenue by revenue is going up. Great. I see the cash burn. There's going to be some kind of dilution event, or there's going to be a debt issuance. Would I buy this stock right now after understanding the fundamentals? And if the answer is no, maybe you need to admit that you made a mistake. Okay? So that's it. I don't have all the answers for you, but I'm here to tell you have some options. If you sell at a loss, you can use that to net capital gains. You can actually reduce your ordinary income up to $3,000 per year. Let's say you have a $10,000 loss and you decide to sell it. Well, you can use $3,000 this year. You can use, assuming you have no other gains to offset, $3,000 this year, $3,000 next year, $3,000 the next year, and $1,000 the following year. Those losses carry forward. So you can save money on taxes. It's not the end of the world. You can continue to accumulate shares, which is great if it's a good company, but you need to actually do your research and really, understand why you bought the company. Or you could hold the shares and potentially have some massive opportunity costs. So I can't give you any of you a direct answer. Like if you call me and say, hey, Chris, what should I do? I can't tell you. But if you bought the stock because somebody told you to do it, you need to think hard about potentially moving out of it, okay? But I'm not going to give you the direct answer. That's up to you. Anyway, that's it. Hope you guys have a wonderful day, and I'll talk to you later. Cheers!